Hello everyone, and welcome to our second aviation-based financial clinic. My name is Louise Ramadan and I'm co-founder of the Aviation Base. We're joined today by Oscar Hjalmas, who holds the position of Chartered Wealth Advisor and Fund Manager. He specialises in investment and pensions, joining the industry in 2006. Oscar is a fellow of the Personal Finance Society and a member of the Chartered Institute for Securities and Investments. Today we'll be exploring what happened with GameStop first, and then how equities are priced, what to look out for, and what to avoid to become a long-term success. Just a couple of things before I hand you over to Oscar. If you have a question at any point, just write it in the chat box, and you can highlight it by clicking on the little icon next to it. It should turn red just so it's easier to see where the questions are. And Oscar will answer all your questions at the end of the presentation. And finally, if you disconnect for any reason, you can just click on the little reconnect button at the top and it'll bring you back in. So over to you, Oscar.
Hi everybody, and thank you, Lou, for that introduction. Like Lou said, today we're going to talk about equity, and because we've recently, or as most people have seen in the news, we've had the GameStop saga. I thought it'd be a really good starting point. We are going to talk about one of the slides, if you saw the last lecture or seminar, about supply and demand. So where supply meets demand and why things are priced as they are. Now, there are probably one of the most famous investors in the world is a guy called Warren Buffett. And he does something called value investing, and we're going to talk about a lot of these terms in more depth later. Basically, what it means is, and this is how I invest as well, and I think fundamentally this is how most people should invest, and it is called fundamental investing. So you look at what are the building blocks of the investments that you are making, and whether or not you think they're going to be profitable in the future, if they're going to be able to grow their business, and then you invest. At the moment, with stuff like GameStop, you've seen people invest in their stock that haven't necessarily looked at the fundamentals. They've just become a meme stock where people have just invested for the sake of investing, and then you see share prices fly through the roof, and then you see them crash to the floor. So we're going to talk about it, and the reason why this is so important for everybody when it comes to you investing for anything in life, from trying to save to buy a car, to buy a house, for education for your children or grandchildren or anything like that, is when you invest in stuff that goes up in price very quickly, it usually falls very quickly, and you have to have the fundamentals behind it. Something I've studied a lot, and if after this lecture or the seminar you want to talk to me about it, or it's the tulip crisis, which basically tulip bulbs in Holland sold for as much as houses. It's one of the first classical bubbles where you would literally see people running out into the street with their deeds to their house going, I will buy a tulip, because they thought that someone else would buy it for more. This is known as, and this is a way you absolutely should not invest, the greater fool theory. So if you buy something just because you think it's going to go up in price for no real reason, but because you think someone else might buy it for you for more than you bought it for, that is the typical thing that people do that is horrendous. We saw it with Bitcoin when the price 10 doubled in 1 year, where people went in to invest, not because they actually want to use Bitcoin, or they thought that they were going to be able to purchase stuff with Bitcoin to use it as a currency in the future, but because they thought they could sell it to somebody else for more money. So I'm going to start the presentation, and I hope, and if someone could just quickly type into the chat box for me that they are able to see the presentation, that would be great. This slide I showed you before, or I showed in the last seminar, but because it's so important, it's fundamental to absolutely everything that you do in investments. I just need to go through it one more time. So the downward sloping line is D, or demand, and the upward sloping line is supply. So when demand meets supply, you produce Q1, as in you produce X amount of quantity and you sell it for P1. Now, I said in the last one, if you understand this very, very simple graph, you could virtually be an economist, because what happened, so we're gonna go to GameStop straight away and say why this is not something that I would ever personally put my own money or my clients' money into. What happened was that the demand for the stock went up, which means that how you do that is you go up the demand line. So you actually go to the left, and what happens is that the price follows, because you have such inelastic, it's called supply, because you only have a finite number of shares in GameStop. The price, because demand doesn't move by that much, goes up and up and up, quicker and quicker and quicker, because there's no one selling their shares to the market, which means that people are buying it for more and more and more and more and more. Now, you heard about, so I'm going into quite a lot of detail on this GameStop stock, but I think because it's such a good case study of what can go wrong, it is something that I just really want to talk through with all of you. So what had happened was that a lot of hedge funds had borrowed stock from other people and sold it, and that's called short selling. So they had tried to push the supply line, the line on the S, to the right, which meant that demand is less than supply, which means that price falls. Now, in this scenario, you borrow the stock and you say, right, okay, I'm going to sell a million of these shares, and by doing so, I hope to make a profit, because I think, and this is the greater fool theory again, I think that it's going to fall in future. I don't think the fundamentals are there. I think it's going to fall in future. So I think that I'm going to be able to buy it back at a cheaper level. What you have to do, because you're selling something you don't own, you have to tell the traders or the market makers, you have to say, well, I will buy it back at X. And one of the bigger hedge funds, the price was, and I actually have the price. I'm going to cheat very quickly. I'm going to go back to this slide. So here the price was about $40 a share. So the hedge fund trader will have said, right, okay, well, it's at $40 a share. I will buy back everything and make a massive loss if it hits 50, say. And they never thought it was going to go to 50, but you have to put a stop loss in. So what happens is that from pumping shares into the market, you're not having to reverse your position, because you have to buy these stocks back. So the people that sold down and flooded the shares, the market with shares, were then made buyers, which, as you guys now know, if you move further up the demand line, price will go up more. So price goes up more. Supply is even tighter, because you've got these people who sold a million shares. They now have to buy those million shares back, and you get this bubble effect, right? The issue becomes compounded, and I can now go to the graph in earnest, and you get this massive spike, right? So the share price went from, I'm sorry, you can't really see here, but it's about, I think it was about, say 30 to 350, right? So that's over 1,000% increase in the share price. Now, here's where the really interesting thing started to happen with GameStop, because at this point, a lot of other traders came into the market and went, hold on a minute, I am able to sell this short now. So I'm going to start borrowing shares of people, yeah? And I'm going to sell in the market because I think the fundamentals of this company, you can argue that it wasn't worth as little as this, but I think no one is going to argue that it was worth as much as this. So what happened was you got a lot of traders and hedge funds who went, well, we're going to start selling the stock. At the same time as the people who use the app Robinhood, which is a free trading service, were unable to trade. They were unable to buy more to push the price up. Now, there's a lot of stories about why there's this. The official story from the Securities Exchange, which is the US regulator, which is where the stock is listed, is that the Robinhood app had to give collateral, as in they had to give money to the exchange to make it so that people could continue trading because it was seen as such a bubble and it was to protect people. Another school of thought, which I much more subscribe to, is that hedge funds, the reason why Robinhood was free was because hedge funds and hedge fund managers paid Robinhood for their data. So they paid to know the trade flows of what went through Robinhood so that the hedge funds could make money off trading either like those traders or take the opposite position because they thought that other companies that they traded in was going to go down. So you saw, and this is the downturn here that follows the massive spike, because there was no more demand. So I'm going to go back again. So demand, because they couldn't trade, started falling, so price fell. And then they were able to trade again because there was public outcry about this. So you saw it go up again, at which point the large hedge funds and other industry experts, me included, and I was very vocal about this, now is the time to sell this stock. It is massively overvalued. The fundamentals aren't there to support that price. This Robinhood trade will at some point run out of steam because even though they kept on buying, pushing demand up, if you then are able to shove demand the other way, or they stop buying, which at some point they're going to run out of money, yeah, you're going to see demand fall back to the equilibrium because it always does. This is where demand and supply, this is where it belongs. This is where it will always go to. It falls back to equilibrium. You will then see a correction in price. And it went back to virtually, not exactly, but virtually what it was before. Now, this is where the story, this I didn't predict. The first part I was bang on the money. The second part here, which is where the trades are a lot slower. So what you could get from this information here, where on about the 23rd of February, you see the price increasing again, is that actually the stock is worth much more than it was pre this ridiculous spike. The stock should be worth more than that because the fundamentals support it. GameStop is a well-known company, has a strong balance sheet. I think that the stock should not be pushed so far down by hedge funds managers. So the stock has started to creep up. Now, probably a little bit too much by now, in my opinion. I've done some models on it, but it's still supportive of the 150 level. It's not supported at the 350 level. So this here, the second spike, as you can see from February, is justified. The spike here in January isn't. This is the difference, and this is exactly how you should invest. Yeah. When people are greedy, as they were in January, you should be scared. And when people are scared, you should be greedy. So investing on fundamentals, this price level can be supported, and people have made a lot of money here, right? The only people, I believe, that made money in the January, early February nonsense were either hedge fund managers who won money on the way down, or the people that were first into the GameStop trade and then went out. And that's why the person who's behind all this, who doesn't even have a license, by the way, is potentially going to be going to jail for it because it looks like he made a bunch of money before everyone else was able to get out. So always invest in fundamentals. Now, I understand that obviously the aviation base is very aviation driven. I've talked to a lot of pilots in my day about how they should invest, and I've said to them in the past when they've come to me for stock advice, I've always said, whatever you feel is the best company within your industry, because you have more knowledge about your industry than I do, that's probably the company you should invest into. And whenever I felt stuff is a bit toppy or the share price isn't supported, I've been very vocal and told my friends and family that they should maybe look at selling some of their shares out. I haven't always been listened to, but it's this that drives all the decisions that I make, and that you should make when you invest. It should always boil down to the fundamentals. Stuff will go in and out of vogue. You'll get massive spikes in Tesla, for example. We've seen the share price of Tesla go down by a third because, again, it went up too quickly and the fundamentals didn't support the price. So again, I'm sorry, I keep on showing you the same graph, but if the fundamentals aren't there and demand falls back to meet supply, that's where your price will be. You cannot get, it's an axiom. You cannot get away from this law. You can, for a short period of time, support a higher price, but it's only going to be for a short period of time. You need always need fundamentals to come in. And whenever you see spikes like this, please stay away. It's not going to be a quick buck. There are very intelligent people doing very intelligent things with stuff like this, and they win. Invest through them, but don't try and do this yourself. This is actually, I believe, this is my last slide. I want to talk to you all about fundamentals and what a fundamental is. So what company should I invest into? So that that's fundamentals wrong there. And when pilots have come to me in the past and asked what company should I invest into, I've always personally liked EasyJet. I think EasyJet is a fantastic company. They used to have their old CEO, Karen, I think this was the CEO, was an amazing boss. She really knew how to run a tight ship. They provided a quality product at a good price. They had strong balance sheets. So I always said to people, I think this company is going to do well over the long run. I would happily put my money with EasyJet. Other companies, for example, like Ryanair, who I understand, they haven't done badly in the stock markets, but they haven't done as good as EasyJet. Is because the only reason I wouldn't have wanted to put my money with Ryanair was because I didn't feel like the business model and the product that they were providing was sustainable over the long run. Always, whenever you invest, think, what is this company doing? Do I see a future in it? So at the moment, we're seeing a lot of, so if you invest through other people, you invest in funds, you don't invest directly in equity. We're seeing a big rotation, it's called, into environmental, social, and high governance stocks. The prices are massively supported in these stocks now because you want to invest in a company who is aware of the environment, is socially responsible, and has strong governance, as in a strong board and stuff like that, who are able to make positive decisions. Those are the kind of companies and the kind of funds you should look for to invest to in the long run. And yes, they can fall. So if we go back to the GameStop slide, you can invest in something and you can be 100% right, and you can invest for all the right reasons, and the stock price can still fall, like the opposite of this graph. It doesn't mean anything. It just means that you were right too early. If you stick to your guns and you continue to hold it, you will do well. There's a famous saying as a trader, if you buy something and it halves in price, you should do what's called doubling down, which basically means you buy twice as much. Because if you're happy to buy it at, say, £1 and it's now fallen to 50p, well, you should be chuffed to bits because you should buy twice as much stock, because you're obviously thinking that it's going to go to at least £1.50. So whenever you look at your own investment portfolios or anything like that, be it equities or stocks or shares, never look in the short term, always look in the long run, and always try and get the fundamentals through. Now, I've said a lot there, and I feel like I've been relatively clear, but I would like to move to Q&A if there's any specific areas that people have some questions in, or they feel like I should talk about more and clarify more.
Hi, yeah, so if anybody has any questions, they can put their question in the chat box. I have a few questions, please, Oscar,
Yes.
of my own. So, first of all, I would like to know what the whole GameStop saga meant for the people actually running GameStop. What would that have meant for them? Did they get any kind of financial benefit from what happened?
So this is the really funny thing. So what I'm going to do is I'm going to take us off slide so we can see us a bit better, I think.
Yeah.
No, nothing. This is the weird and wonderful thing. So I don't know if they sold shares or not. They might have sold their shares, but if they didn't sell their shares, it didn't make any difference. The only thing that's good about having a higher share price and a higher what's called market capitalization, i.e. your company is bigger, is that you can borrow more. That's it. There is no fund. For the people in the business day to day, it makes absolutely no difference whatsoever, unless they sold their shares. So if the people who ran GameStop and they, at the top, they went, oh, well, I'm going to sell 10% of my shares. I mean, fantastic to them, right? They deserve it. But if they didn't sell, which I highly doubt they did, this whole thing has generated no profits for them at all, because your share price isn't linked to your profits, how much you make, what you make, or what your business is. So it will have made very little difference to them at all.
Okay. Another one, does a company have to be, this might be a really stupid question, but I'm like coming from zero financial knowledge.
No.
Yeah, so does a company have to be publicly listed for it to have shares that people can invest in? Is that the way it works?
Yeah, so any company has shares. So when you create a company, even if it's just not sole traders, but a private limited company, like the aviation base, I would assume, you will have a share that you could buy and sell on the private market. But to be on an exchange and for your prices to do this crazy up and down, yeah, you have to be listed. How that usually works is through an initial private offering. The most famous one, probably for our recent one, was the fantastic lady who she started Tinder, and then accused Tinder of sexism and moved on and created her own. I can't remember what the company's called though. I can't remember what she's called. I'm really bad with names. She created her own company, and she sold, I think it was like 30% of her shares and put them on an exchange in an initial private offering. And people paid so much for those shares that she made herself a self-made billionaire, I think, in a very, very short period of time. So that's amazing. And that's how you can make money as an owner, by going to the exchange. But once you're on the exchange and you have given away your shares, or sold, you haven't given away, once you've sold your shares, there is no benefit to you with the share price going up and down unless you sell further equity.
Okay, interesting.
And you have shares so that you either participate in the profits of the company or you're able to vote. So if you own 30% of a company through those shares, you then you can vote at the meetings and stuff like that on how you want the company to be run.
Yeah, because there's a couple of like eVTOL is very much an emerging market in aviation, in the aviation industry, and there's a couple of companies that are trying to get publicly listed at the moment. So that's interesting. It'd probably be quite wise to invest in them. But then it's knowing which ones to invest in, and like, because there's so many companies right now, and you know that it's only going to be a few that make it. So
absolutely.
Yeah.
So what they're doing is they're saying, right, they're going to market. It's called. So say they value themselves at £10 million, but they don't have any cash. But they value their ideas at £10 million. So they go to the market and they say, "Hi, Aurora." So they go to the market and they say that they want to raise capital. So they turn around and go, "We'll sell 40% of our company for £400,000. What they then do with those profits is they actually reinvest that into the company, and that's how it works. So that's how you can make money and put it into your company. But again, that only really works once, and it's very risky because usually you get investors that are a lot of companies are destroyed that way. So like you lose quite large control of your company. They are called private equity firms, are usually the people that buy your stock. They're usually quite aggressive investors and require a certain return. And there's a lot of companies, great companies out there that have been completely destroyed because their investment ethos and the way that they want to do stuff is not the same as the people that are coming and bought their company, and actually ends up destroying value instead of creating it. So whenever companies do look to raise money, they should be very careful with who they sell their shares to.
Like there's one I saw recently is being invested in, or it's it's called a SPAC. I can't remember what the letters stand for. I know the A is acquisition, special.
Purpose.
But this is one of the special purpose acquisition company. That's it. Yeah. So this is one of those investing companies.
Yeah, exactly. So if you said something really good then. You were like, I don't know which one to invest into, right? It scares me because a lot of them is going to go bust. So what you can do is you can set up a SPAC, or someone will set up a SPAC, and they'll say, right, we're going to go out and we're going to invest in 10 companies. We know that 8 of them are going to fail, but we know that 2 of them are going to go gangbusters. So you give, instead of you going £100, £100, £100, £100, which you probably won't be able to do, you give the SPAC £1,000, and then they go out and buy the shares for you.
Okay.
So it's a way to invest in these much higher risk industries. But the best thing you can do, and like we talked about before, and fundamentals, is you go out, you do your research, you look at the company that you believe the most in, you talk to the managers, and you go, no, actually, I'm going to give you my £10,000.
Okay, thanks. Right, I'm going to go to the questions from the audience. Thanks for answering them for me. So first, in the aviation market, would you be looking at individual airline strategy for sustainability? And are airlines a risky investment given the impact of the COVID crisis, or is it now a good time to invest?
So that's a really good question. If you think about what I said before about once something goes down in value, that is the time to invest. So I'm going to try and share my screen quickly. Can you see my screen?
No.
No.
Maybe I need to turn my video off. Let me try.
No, okay, I can't do it. But that's okay. If you turn your screen back on, Lou. Basically, EasyJet before the pandemic was trading at £15 per share. They went down as low as £500 a share, and they're now trading at 1,000. So it is really good to invest in these companies when they are low. So you could have doubled your money in EasyJet if you decided to invest last October, and the share price has gone strong since then because of the news on the vaccine and stuff like that. So yes, I would absolutely look at the fundamentals and sustainability of the company, 100%. Chaos is great for investing because the companies that have the best fundamentals that are able to survive will obviously get more market share, because the smaller airlines that aren't able to cope with the pressures of COVID, they'll collapse, and those routes and those airplanes potentially will be picked up by the ones who survive. So if you believe that EasyJet will continue as a going concern, absolutely, it's a fantastic investment. And the good thing is, and the really interesting thing is that you know how much they should be trading at, because pre-pandemic they were trading at £15. So you have a really clear, like, where do I think the price should be? Well, you had it was trading at that at £15 or £15-ish for quite a few years. So you know that that's probably the level that they should be sitting at. So absolutely, 100%. Look at the fundamentals of the company, look at the sustainability of the company, and then if you perceive the share price to be cheap or trading below old market average levels, then it's probably going to be a good investment.
Okay, thank you. Another question, FTSE 100 versus 250. Do you still think the 250 has better prospects?
Yeah, so that's a massive UK question. The FTSE 100 is the Financial Times Securities Exchange 100, which is the largest 100 companies in the UK. About 30% or less, I think it's 27% of the profits of those companies come from within the UK. The rest are from abroad. So like there's a lot of like BP, Shell, Glaxo, like these massive conglomerate corporations are listed on the FTSE 100. So it's not really a UK exchange, in my opinion. It's more like a global exchange. I don't think that global markets are going to do particularly well over the next year. I think the phenomenal response by the UK government to the COVID pandemic and our vaccination rates means that the UK economy is going to go gangbusters over the next year. The FTSE 250, the next 250 companies, I think it's like 70% of their profits are made within the UK. So I think that that's a much better index we've invested into, because it's UK centric, and I think the UK economy is going to do really well over the next 12 months. So if I was to put my money somewhere, if I had £100, I'd put £20 into the FTSE 100, and I'd put £80 into the FTSE 250.
Okay, thank you. And another question, if someone owns 99% of the company's shares, does that mean that they effectively own the company? Can they dictate how it moves?
In most cases, yes. There are various rules with this, different exchanges in different countries. Once you hit certain limits, you actually have to buy the rest of the shares. So France is quite low, for example. I think it's like 30% or something. So once you acquire 30% of a company, you actually have to go, okay, I'm going to buy everyone's shares of them, which obviously isn't particularly fun. Facebook have done something quite interesting. They have voting rights for all of their shares, but Mark Zuckerberg owns one share that has the ultimate voting right. It's a really weird system. So he can basically, if people vote against him, he can go, actually, I'm not going to listen to you because I own the golden share, which I don't really like, but that's his personal opinion. That's he set up. Obviously, it's his company, so he can set up as he wants to. It's nothing he hides. So, but that's like a golden share. So it does. If I bought 99.9999999% of Facebook and he still had his one share, he would still technically decide over the company, even though I own almost the whole thing. But yes, that question is really good, and you're right. And the more shares you own, the more your voting rights are. So that's why a lot of like companies and their pension funds, when they invest in certain companies, they are what's called active investors. So they will ask their members, who actually are the owners of the shares, to go, how do you want to vote on this resolution? So if the company suggests that they're going to start using solar panels for most of their energy use, you can then vote in their annual general meeting at AGM and say, yes, I think this is a good idea, or no, I don't think this is a good idea.
Okay. If anybody has any more questions, then just pop them in the box before we go. But I have one more of my own, which is, do you know of any good apps, any good investing apps for people who are just beginners, maybe to investing? And could you recommend some apps?
Yes. So there are a few. So it depends on what you want to trade. And what you want to look into. eToro is a really famous app for everything. It's a little bit complicated, but it's a very comprehensive app, and it's very cheap to trade on it. In the UK, Hargreaves Lansdown is a really big company. They do really simple investing and investment plans for people. I would highly recommend them. And then my favorite one, and this is a global company, they're called Vanguard. They're a little bit different. They don't have shares. They've structured their company very differently. So they've structured their company as a mutual, which means that when you invest through them, you actually automatically get part of the company. So if you invest £1 million and they have £100 million worth of investment, you actually technically own 1% of that company, which I really like, because it makes it much more like, as the client, you're also the owner. Vanguard specialise in something called passive investing. So they look at indices, like the question before about the FTSE 100 and the FTSE 250, and they replicate those. They're very cheap, they're very easy to use, and long term they have proven to give phenomenal results. So if you have a child investment or anything like that, I would, for my own daughter, that's who we're invested with.
Okay, so do they have an app that you can just download and then you can invest through them? Vanguard.
Yes.
Okay, and how is the first one spelled? eToro.
eToro. It's E and then Tango, Oscar, Romeo, Oscar.
Okay,
hopefully I got that phonetically right.
Okay. Yeah. Okay, perfect. So yeah, if nobody has any more questions, then I'd like to thank you for your time today, Oscar. That was brilliant.
Oh, thank you for yours. It's been really good. Thank you so much for having me.
Yeah, it's been a pleasure. And just before you go, if you enjoyed this clinic, please make sure to check out our website. It's www.theaviationbase.com, and you can find all our previous webinars and clinics on there. So thanks everybody for watching, and we'll see you next time, Oscar.
Thank you.
Bye.
Bye.